The only goal of doing a deck is teaser, right? It's to tease the investor that they actually want to learn more and do a call with you. So don't have too many words on there, more graphics, try to be as clear as possible because all they need to figure out within seconds.
Welcome to the Startup Huddle. I'm your host, Jozef, and I'm excited to introduce you to the current and upcoming leaders of the startup tech world. We'll discuss digital products and key takeaways for life and professional growth. So grab a coffee and let's huddle up. Hello everyone. Today we have here Stephanie Rieben from Diadem Capital. She's an expert on fundraising and everything related to that. So this is what we are going to mostly talk about today. Thanks very much for coming, Steph.
Thank you, Joseph. Thanks for having me. Also, we had a great event last night in New York City, so it was nice to see you in real life instead of just the
Indeed.
little 3D Zoom that we normally see each other.
Great. So before we get into all the nitty gritty about fundraising and all the details, can you maybe explain us your background and where did you get all the knowledge about fundraising, what you're doing right now, and everything that you deem relevant?
Yeah, totally. So ex-banker turned startup founder. So I spent a decade on Wall Street, was first at Goldman, then at Citi, then at the German bank called Berenberg Bank, because I'm originally German, but I've been now 17 years in New York City and only worked in banking in New York, never anywhere else. But Berenberg Bank is the one that got me into the tech world. So first I worked in investment banking, then equity sales, and Berenberg Bank, I ran relationship management for them to basically help the asset managers, hedge funds, etc., get access to companies. And there we were very focused on private companies that are about to IPO. So we're looking for pre-IPO companies in the tech world specifically, because Berenberg writes research on the regular gig sectors that the 11 industry sectors are that bulge bracket banks cover on the equity side, like public equity side. But Berenberg has a spin where everything they write on has a tech angle. So financial services, it's fintech, healthcare, it's medtech, biotech, real estate they wrote on like data centers. So that's where I got like this interest into the tech world. So 2018 is where I left and joined my first fintech startup. So I worked for two fintech startups back to back. Both were funding marketplaces. Both were raising their Series A, and both of them I helped the founder raise the Series A by making like VC intros. And that's when I started getting like this Google sheet together with like VC funds. And then I was like wondering, why is there not a platform out there as an ex-banker where it's normal? I worked at Goldman and ECM, so we did like follow-on offerings and IPOs back in 2009 when they were like hot before the crisis. And we it was normal that like as a founder or issuer in that sense, because it's a bigger company, you work with bankers, right? But in the private world and especially in the venture side, it's not as normal. So that's how I came up with the idea together with my now co-founder Joe, who worked with me at Citi for 5 years where we're on the same team, to create a platform where basically we are a deal flow engine for startups and VCs to get connected. So we work with like strong venture-backed startup founders and connect them to VCs as well as venture debt lenders. So by now we've amassed like over 900 VCs and over 100 lenders that basically are looking for private capital deal flow. And we work on the equity side with seed stage companies through Series C, so really early and growth stage. And then on the debt side, we do everything. So we connect them from like 100K inventory line they might need if it's a small CPG company to like warehouse lines like a fintech lender may need when they want like 100 million, 200 million line. We have lenders for that as well. I'll stop there in case you have like more specific questions.
Thanks for the introduction. That makes sense. Indeed, what you described, the fact that you are, I mean, there are, or at least I've seen in the past, people playing with that idea, and many people would say that it's not going to work because VCs will not be happy to share the money that they or pay a commission from the money that they invest in the startups. Well, but apparently it works. So can you maybe tell us why both sides actually like the solution, and why maybe there are certain misconceptions about what's possible in that space?
Yeah, definitely. So we are a very different model than the traditional banker. We always say, Joe and I, we're like the anti-banker model. So number one, we have a very different fee model. So we do not have any upfront fees. We don't have like a monthly retainer. We don't have like a SaaS model because we have a tech platform. Instead, we charge a success-based fee only based on the capital we introduce, and it's only 3% on equity and 1% on debt. And the 3% also, we have a waterfall. So the bigger the raise, will go down in like different tranches as the capital comes in. And we also do a hybrid where we offer a cash fee plus we take equity in the company. So instead of doing a 3% cash fee, we sometimes do a 2% and then 1% will take an equity or even 2 and 1, vice versa, depending on the founder interest in having us also on the cap table. And it helps because then it also shows that we have skin in the game, even though it's not our own balance sheet money per se. And of the 21 companies we've raised capital for, 17 were actually VCs referring us their portfolio companies. So portfolio companies come to us because they want to raise. VCs come to us because they want their portfolio companies to continue to raise. And actually, all the VCs we're working with, because we have 900 now that we consider as partners, they say, wow, you're actually very reasonable with your fee because you're actually also a true value add. Because VCs typically, they might lead a pre-seed seed round, but they're not going to lead the A. So then they say, hey, Steph, maybe you guys can help us get a new lead for the Series A. Or they are the lead, they went to their co-investor club because typically VCs work with maybe 5, 10, 15 co-investor firms that they typically do deals with, but then that's it because every VC kind of has their own little ecosystem, but then they're tapped out. So then they come to us and say, hey, maybe you have more co-investors that could come into a round. We do both. So we'll help with a price round finding the lead. We'll help in a price round getting co-investors. We work on safe notes. Last year we called it like the year of bridge rounds because 2023 wasn't like the best year in fundraising. So we did a lot of bridge rounds. So helping startups get from A to B or C to A. And that's really where we come in, is trying to help get additional capital into a round. So it's not like expected from like the poor startup founder to like drive down Sand Hill Road in their beat up car and like knock on a bunch of VC doors and then they're the wrong VCs. Because where we come in is also we send pre-vetted, curated deal flow of actual fundable companies to VCs. That's why we hover actually at a 75% founder funded rate of the companies we take on. Because our clear message is we only work with startups that we think are fundable. So we don't want from VCs the startups that are like they're low, like basically the ones that they've written off already. And then they're like, oh yeah, maybe Diadem can help. We actually want the strongest ones because the strongest ones are the ones that get funded.
And which ones are the strongest ones from your perspective?
Yeah. So it depends. So at seed stage Series A, we have different metrics that we're looking for. So typically we have we're sector agnostic for across like verticals, but B2B SaaS obviously is the biggest one. So of our 900 VCs, I would say the biggest round brunt are generalist funds in the B2B SaaS space. Then we have about like 150 or so that are very specific fintech. We're headquartered in New York. So a lot of like funds are East Coast and they focus a lot on fintech and financial services because it's like New York City. We have a lot of funds in Florida, Georgia. We have so Atlanta, Salt Lake City, Utah, Austin, Texas, Minneapolis, Chicago, and we do have Silicon Valley as well. But the biggest number of VCs that we have are also more price sensitive. So what we typically look for is a B2B SaaS company at seed stage that is getting to 1 million in ARR. At Series A, we like to see between 3 and 5 million ARR. And then we look at companies that are venture backed already. We want them to have like growth, right? Year over year growth, at least one time, two, three times the best. Obviously, that's tough in this market, but we've worked like our very first deal was a Series A of a B2B SaaS founder in the ad tech space. And he was at Series A at 3.5 times year over year growth. Stellar company. We got them a great lead, was like a 3 million co-lead that we got him in the 7 million Series A. Then at seed stage, it's typically like 800K to 1 million, 1.2 million, like an ARR that we're looking for. And then that's B2B. On the CPG side, the numbers are much higher. So CPG or direct to consumer, the VCs that we have require a lot more traction. So you're looking more at like seed stage, even hitting 5 million in revenue. So we've had like true CPG product companies like apparel that had 9 million revenue at seed stage. And they were doing like a 5 million seed round. If it's like a CPG product that's like in stores, most VCs require not 2,000 stores or 3,000, they have to be like in 4,000 stores minimum. And then a lot of like food and beverage, for example, it's also what's their wholesale strategy? Or are they only selling out of Trader Joe's and Walgreens, well, what's it called, Wegmans, etc.? Or do they have a proper warehouse strategy and wholesale strategy where it's more of like a B2B aspect as well? Those are some of the things. And I can go into more metrics if you want to hear about metrics as well.
You mentioned quite a few things of what you consider to be a good company or a fundable company, and maybe let's dive into that. Of course, like one is the revenue. Now, um, I'm not sure how much. Of course, you guys work with companies that already have revenue, but you see the whole market and you know how to raise money. What about the earlier stages? So let's start with the earlier stages. Do companies currently need to have revenue to raise money, and how to solve that chicken and egg problem that in order to get revenue first you need to build something, and but yeah. So how do you see this?
So I think in this environment where it's really not hard to build a product, you cannot raise on an idea anymore. Like I have not seen any deals be raised anymore on based on like a napkin idea, unless you're a couple not to be named, they might be able to do it. But if you didn't have like the network, you didn't have like four exits prior, and your name is known, and VCs like Andreessen or Sequoia backed you, it's going to be very hard to raise based on an idea. So what we're looking for is like even at pre-seed, you need to have like 100K in revenue. Like before that, you need to have some kind of that's not even proof of market. So proof of market fit, I see only VCs accepting at like 1 million. Like the 1 million mark is like that golden number where it's like, okay, we're past like it's product market fit, like we're past like the proof of concept. Anything before that, you can build like we built a bubble, right? So for obviously you want to work with like tech agencies like yours, but you can do like your most rudimentary MVP very easily in like tools like Bubble or like there's easy tools to do just to have something to show. It doesn't have to be like pretty UI, UX, etc., right? Just to like prove, okay, we have a platform and have maybe one or two clients try it out already. It can be a pilot. But that's like what we need to take a company on. And typically at pre-seed, we're seeing a lot of companies that actually have done that. And then the ones that inbound us, so we get a lot of applications. We've had in like the past 2 years, almost like 2,000 companies inbound us that come through our platform with like a portal. They can apply, and then they go through a scorecard. And depending on the scorecard, that the score that they get a first call. And then we dive into the data room, post NDA, and then we have a second call just to go through like some VC type questions. But the very first things they need to hit is there a product? So there needs to be an MVP. Is there some kind of revenue for us to like take a look and see maybe it's a fit for our pre-seed investors? But our sweet spot personally is a 2 million seed round and approaching 1 million in revenue. We do one-offs where we try to help some companies if they're in specific sectors. So that's one thing to mention as well. So at pre-seed, B2B SaaS, especially if you're planning to build like an enterprise SaaS company, we'll talk to you. If it's a CPG company that has an idea, no way, because I know no consumer VC is going to look at it. Because we always look at we're not saying no to companies just to say no. We only can take on companies that I know personally because I have all these relationships with the VCs that certain VCs are going to look at because we're in the business of making warm introductions. I'm not, we're not cold shopping ever. So I need to already have like 20 VCs in the back of my mind that I think would actually want to talk to this founder before we think we're going to take somebody on to like really help them with their fundraise.
It makes sense. Again, touched quite a few interesting topics. One which I would like to talk about is how. Uh, so the biggest value of your service is obviously the fact that you know which companies, evaluating companies, but then also understanding the investors and companies trusting you. So when you make a connection, they actually spend some time on it. Now, what about so that's great value add of your service. Uh, if you don't take on certain founders, or if certain founders do not want to maybe work with a service such as yours, how they should contact the investors, especially if they're early, whether it's early stage or later stage. Uh, people don't know how many emails should they say. Some people say that you need to meet investors personally at the events. Some say that you should just kick out the door if you really need to talk to them. So what's the normal like best practice strategy of getting to the investors?
Yeah. So warm intros is I think the only way. That's why we're in the warm intro business because VCs get so many emails, like cold emails. So that's why we hover at a 94%, 95% email open rate. Like when our email alerts go through, it sends as Stephanie, like the VCs know me, and I have like a 94% email open rate. Because they're like, okay, when Steph sends deal flow, she actually looked at it, they did two calls. It means like it's definitely pre-vetted and she thought that it's like interesting enough for me to take a look. If you as like a founder are cold inbounding, it's hard because how can you make just your subject line interesting enough that they will open it without thinking, oh, you're just selling them something. So that's tough. Obviously, yes, try cold email, try LinkedIn. But the most important thing is try to find somebody that knows somebody who knows the VC you're trying to get in front of. And I think a big mistake that a lot of founders are making is they try to go straight to like the partners and the GPs, go to the actual deal sourcers because the deal sourcers are the analysts, the associates. They're the ones that do the first calls anyway. Even if the partner says, go talk, I'll do a call, he's not doing the call. He's going to send it to an analyst or associate to do the first call. Then they do maybe a second call with you. They might do a third call with you before they write an investment memo up, that then will go to an IC meeting that typically happens bi-weekly where they decide, oh, do we want to dive deeper into this company? Yes or no. So your goal is, how do I get in front of the person that will get me into the investment memo where they speak about it at the IC to decide, will we actually talk to these people more? Some funds, like we heard FFVC yesterday, have like this application link they use where founders just have to apply. So a lot of funds have like a website where you can just go in and you can apply, and then maybe something will happen or you end up in a CRM to never hear back again from, right? So that's where we come in also because we circumvent that. Like you don't have to apply on a website when you come through us. Like we will send you straight to like the actual people that will make a decision if they want to do a call with you, yes or no. And they know what the theme is. So what we also talked about is we at Diadem help you figure out what VC is actually deploying capital. Because I do quarterly calls, so I know, are they between funds? Actually, are they deploying capital? How much do they have left? Or are they only keeping the last bit that they have left? Because typically 30% they use for follow-ons in existing portfolio companies. They're not going to write a new check. And then if they're trying to fundraise, did they have a first close yet? If they didn't have a first close yet of like the next fund, I'm not going to be able to deploy capital. So those are things to keep in mind. And there are other like platforms that are more competitors to ours, but that have a different model that might be a fit for more early stage companies. So there's obviously NFX's Signal, which is basically like a big phone book of investors where you can just go in and double check and see and try to inbound these guys on LinkedIn. I don't think all of the data is correct. So when I double check some of our VC investors in there, I'm like, oh, they're tagged wrong by sector, they're tagged wrong by ticket size, etc. But it's like a good way for free to be able to just like scan the universe and be like, okay, who could potentially be a fit? And then there's all these like cold lists that are being circulated on LinkedIn where I would be careful because a lot of them are outdated. A lot of times I actually find Diadem Capital on the list where I'm like, we actually don't allocate funds. We just match make, but a lot of times we're on it, which is fine by me because that way I get like some founders inbounding us and then I'll talk to them and tell them how I think we can help them with a fundraise. And events, obviously, like you mentioned, events are helpful and they're back, right? So COVID seemingly is over, even though apparently in the winter in New York here, we do have like a little COVID rebound, but like there's a lot of VC events happening, right? And we have FinTech Week around the corner in April. There's a lot of tech weeks. There's a lot happening in different sectors. So whatever your sector is as a startup, try and figure out where are the events, like where are they happening in SF, in New York, like in different regions, wherever you are. And if you can afford it, send at least one person from your team just to go there and talk people up. All these events that I go to, it's full of pre-seed companies. I don't see a lot of seed or Series A companies going to conferences. So at the early stage, that's apparently what others are doing as well.
Are like I've seen so many, of course, like because we tend to work with between pre-seed to Series A companies and startups. We are also many times on the ground, and it sometimes even feel like the VCs are trying to like avoid the founders because they don't have a minute for themselves at the bar during the conferences. So is it how would you approach maybe networking with the VC at the venue? And how much is enough? It's like because everyone just screaming their pitching and screaming their pitches at the person. So what would you say is the right way?
Yeah, it's funny. It reminds me. So I got an MBA at Georgetown. It reminds me of all the informationals you did when you were trying to get into an industry. So I was trying to get into banking. So we did sessions with like Goldman Sachs and Citi, and then all these students are hovering around like these two bankers trying to get 5 seconds in just so they know your name. So when you apply, they hopefully get you an interview. It's kind of the same, right? So you are gonna just be a ton of people hovering around like a VC, hoping to get like the 5 minutes in or even 15-second elevator pitch. Have your elevator pitch ready. You should be able to do like an elevator pitch in like the time it takes to ride an elevator. Typically they say 15 seconds, but let's say 30 seconds. Make it like very clear. I'm a B2B SaaS company solving X problem. If you have revenue, get that traction number in there because then the lights will turn on. And they're like, oh, so they have revenue. Because most startups don't have any traction yet at these conferences. So they'll be like, oh, whatever, you have an idea. Is there an MVP? So make sure that you clearly say, okay, we have an MVP. Even if you like have like just a little bit, like try to prove that you have like something. And then good conferences to go to are like TechCrunch or like Money 2020 if you're like in the fintech space, but go to conferences that actually have an app because these apps have all this chat functionality where you can set meetings and typically they have like network areas where you go and they have like high tops and you get to like talk to people. And then you just write to these people. You write to them in the app and you write to them on LinkedIn as well and trying to get 3, 4 people per fund. See one of them hopefully will answer that you get a meeting. It's a hustle game, but it's the game you got to play.
Even assuming that the person gets to actually the VC, and many times, of course, it's not that difficult if you spend enough time doing that, and if you have the connections or use like the partners such as yours. Um, how much the fundraising, whether it's like Series A fundraise or pre-seed fundraise, how much of it is an iterative process or like adjusting to the feedback that I'm getting from the VCs, and how much it is you should just go for the numbers and essentially try to get everyone, and how much to repeat the question to be on the safe side of things, and essentially should you approach like 20 VCs, learn from their feedback, change stuff, and go to another 20 VCs, or you should just go all in when you're raising the money?
Yeah, good points. If you've never raised before and you've never done a deck before, start with a few and get like some feedback. Never start with your top want like VCs. Start with like tier two, tier three VCs to get like that first feedback. But you also have to be careful. There's feedback whiplash, as I call it. So one person will say X, the other one says Y, the next Z, and then you're like on version 55 of your deck because you got like so many different like points of views. Plus, if you have co-founders and then you're all pitching at the same time, you'll come back all with like different feedback. So at one point, you just need to be like, okay, this is our deck, and we'll go out, and then you go like to like stronger VCs and see what they say, and then you can still iterate. But the thing is, how you tell your story is like one thing you can iterate, but you can't change your company, right? So whatever you started is your company. So um take some feedback, like we give feedback on like what should be on your deck, right? It's like the typical problem, solution, traction, TAM, what's your product, competitive advantage, and then if you have customers, get some customer reviews in there. Um, and obviously your ask, but that's like 7 slides you typically should have. When we get decks, they're like 30 slides, and we're like, oh, like you fall asleep, like reading through that. Like it needs to be the only goal of doing a deck is teaser, right? It's to tease the investor that they actually want to learn more and do a call with you. So don't have too many words on there, more graphics, try to be as clear as possible because all they need to figure out within seconds, because we use DocSend, so we track every like deck open. VCs that have asked us for introductions to founders on average spend 30 seconds in a deck. And that's like clicking through the slides. They just look at the header, they try to see that, they look for numbers. So you need to have numbers in there. They try to see like traction, they try to see any kind of venture backing. Obviously, if you have logos to put on there, it's like important. But if you're early on, go for like angel groups, like some names that might be like recognizable. If you went to Stanford, easy, you do like Stanford Angels, but like different like angel groups also by region. Almost every city by now has an angel group. Every region by now has an angel group. Universities have angel groups. So there's like things you can tap into to try and get them in, and then they'll help you get more investors as well.
That's That's a great advice for sure. There's one more question, then we can go to the general mistakes. But how to
Hmm.
set up your valuation?
Yeah.
That's something that a lot of
Actually, when you said
people.
mistake, valuation was what
Yeah.
I was thinking about.
Yes. And
So
I
typically
understand that
at
it's a complete. Sorry, just like I understand it's completely different for like early stage and later stages because the more numbers you have, the more metrics you get, the easier it is to calculate.
yeah,
But what to do like at the beginning and how to do it like later on.
yeah. So that's one thing we always give advice on is in the beginning, your valuation is not important. You should not be like focused on valuation and negotiating valuation. You should focus on who's the best investor to help you grow and scale. It should be way more important. How can they help you with channel partnerships with like as a more strategic even if it's their portfolio companies where there's synergies, that's more important than your valuation. At pre-seed, we're seeing right now here in the US ranges from 4 to 8 million as a valuation. At seed stage is really anything up to 25 million, but really most of our seed stage funds have a sub 15 million valuation cap. Some do 20, but I haven't seen it a lot anymore. And some do 25, but that honestly, I think we have maybe two VCs that now go up to 25 million at seed stage. That's when there's like true traction. But I think a lot of VCs got burned in 2021 when money was just being thrown around, and they've not had these companies actually grow into these valuations now 2 years later. That now they have to be super, super careful how they invest because they all care about, and you need to think about that too as a founder. They only think about their fund math. Their LPs are waiting for like good DPI, good like MOIC numbers. They're like, okay, well, if half of the fund already you can write off because they all like did really poorly the last 2 years, which were tough for everybody. They're not going to rescue those anymore. So now we need to do better with the rest of the capital that we're deploying for this portfolio, for this fund vintage, to be a lot more clear on like our pricing structure. So a lot of VCs, I also see another way to look at valuation is a lot of VCs say we need to get at least 10% ownership for every check we write. And then they give us like a range of like what the check size is. Then you can back calculate what valuation they will go up to. Um, so yeah, founders at pre-seed definitely don't talk about valuation. At seed stage, it's all like it's not multiples of revenue yet either, because we've worked with companies that had like 25 or 20 million valuation at like 1 million revenue. That's like a nuts like multiple of revenue. At A is then when you see the actual valuation multiples to revenue multiples coming up. So we see like in B2B SaaS, it's like from 6 to 10, but 10 being like really the best because the 10 times ARR multiple was really more 2021, 2022. Now it's like less than that. So we've worked like with a really strong company and they have like a 8 times ARR multiple. That's the one that grew like a lot. And then on the CPG side, the multiples we're seeing is more like 2, 3, maybe 4 times. If it's a San Francisco, so one thing I didn't talk about is regional. So San Francisco Bay Area startups demand higher valuations and they somehow get sometimes term sheets with much higher valuations. But I would actually advise all these startup founders to not take such a high valuation because they're really hurting themselves in the future if they then end up not growing into it. Because then all these companies that 2 years ago had these crazy valuations in Silicon Valley, now they're doing down rounds. And then what VC wants to come in on a down round? Okay, maybe they'll come in hoping that it was just overpriced 2 years ago, but it's like it's a bad signal.
Yeah, I wanted to touch upon because as you mentioned that the last year was the year of bridges. It was also the year of down rounds. How so? Can you maybe explain a little bit what happens in the down round and how difficult it is to get? Maybe if you just need some prior acceptance of the current investors, how does the math work there?
Yeah, yeah. So 2023 was like the toughest year in venture since like 2015. It's like nuts. Um, when you look at like numbers, I think like fundraising, like funding for deals was like down like 50% year over year from 2022 to 2023. So we had a lot of down rounds, but a lot of companies shut down, but actually a lot of funds shut down. I think more than 1,500 funds shut down last year. So if there's fewer funds, there's less capital to deploy as well, right? And then for
And
funds,
can I
it's really
ask,
tough.
did they shut down? Sorry, but did they shut down because they couldn't raise the okay, they couldn't raise the next fund, right?
They couldn't raise,
Yeah.
yeah.
Mm.
And a lot of them couldn't raise because they also didn't have any exits to show. So if you don't have like a good track record, you're never going to raise a new fund because they're like, okay, well, your last three fund vintages didn't do so well. Why would I give you more money? Um, and then what was the question again? Oh, like down rounds. So we've had like companies that had to do down rounds. And then instead of having to do an official down round, they're like, okay, let's just do a convertible note. Let's do like a safe note. Like let's do something where we don't truly have to show that we're doing a down round. And then we bridge ourselves for like a year, scale, and then we can do a proper price round, hopefully where it's at least flat or maybe a little uptick. And then since we help on the debt side as well, we've done a lot of debt last year. So instead of having to do a down round, we did bridge rounds, which also are debt, where we would help with venture debt, which is great for companies that are like at 2, 3, 4, 5 million ARR. Then they can go and get venture debt. It has like warrants attached most of the time. They can get term loans of like 2 to 5 years. And yes, the interest rate overall, when you think about it on an annualized basis, might be something between 18 and 24%, depending on like what your burn is to like revenue coming in, because they look at that on like a monthly basis. But then you don't have to do a down round and you have like another year or maybe year and a half of capital to float your business to grow and scale with marketing, etc., more talent and tech. Um, that then you can hopefully by end of 2024 or 2025 do a proper price round again that's not a down round. So a lot of like firms that we worked with, startup founders we worked with last year were like, why don't you do debt? So we did a lot of debt last year. And then we did bridge rounds. So we didn't do, I think we had one down round last year of all our deals, but otherwise it was like bridge rounds on the debt and equity side where it's basically like a safe note and they don't have to like commit to like a actual valuation.
And what's such an issue with the down round in practice? Is it like the perspective of that you like it's like a mark on your business that you had to do it and it's generally like very badly received in the VCs, or what's the actual issue? Because like of course like you're gonna dilute yourself more and you'll also dilute probably the previous VCs more, but what's the main issue with that?
Yeah, I think one, it proves that the founders mismanaged capital because if you did like a proper valuation, like a high valuation, you might most likely got a lot of capital. How did you burn through that within 2 years without like growing enough your revenue? So it sends a signal that they just mismanaged funds. It sends a signal that they just didn't grow enough. It sends a signal to current investors that they may have done a bad investment because why would they come in the next round? Because that's what that's like the most important signal for new investors is are the insiders, the current investors, re-upping or at least doing pro rata. If they're not, which they wouldn't do in a down round, why would they? Um, it sends like a bad signal for like the new investors. So down rounds are generally bad, number one, because of mismanagement, and just the current investors. There's like no way they would like continue on if they're getting like a lower valuation all of a sudden than before. They want it always, it could go up over and over time.
Yeah, makes sense. And what about the debt? So I've never. It's kind of a special thing for startups. Is there like a sudden spike in how many companies in the past 2 years take on debt, or was it always here? With people just it wasn't just a preferable option, and we're not talking about it.
I think we're not talking about it enough. So private debt has always been around. I think the biggest portion of like private debt is like direct lending, and that's also in the venture world. Last year, I think was like a very strong year for venture debt. I think like 14 billion, like 40 billion or something, um, went into like private debt just in Q4, and it was like in early stage venture, as in Series A, still early, like growth, early to growth stage venture. And then there's like obviously the cap chases of the world. There's like a couple more revenue based lenders out there that look at companies even at like the 1 million revenue mark. And they look at more MRR numbers. So they want to see like every month going up, 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 up. But private debt overall AUM is like in the trillions, like 1.5 trillion, something like that. So it's a big, big space. People don't talk about it and founders don't talk about it because debt always has like this negative connotation. You don't want to take on debt is bad, but actually seasoned founders, so founders that have had exits before, always add debt. Like for us, like who we talk to, the first time founders more like, "Ah, I don't want debt. Second time, three time, four time, five times, seven times founders, they all do debt because they're taught to like build your capital structure that way. So you always, like in banking, I was in banking. When we work with public companies, you always have like your different debt structures. You have your subordinate debt, you have your senior debt, and then you have your equity. VCs typically, if they're on your board, don't like debt as much because they have preferential treatment, right, in a liquidation. So that's like one thing that it's like harder sometimes to get your board on the same page. But then before your company goes under, every VC should be like, okay, maybe we should do debt to help them scale. And also, we do a lot of debt off of an A round. So once, or an equity round in general. So if you've just done equity and you have like a nice 18 months runway, add debt, which gives you like another 6 months to 12 months of like runway. And most lenders only will give you debt anyway if you have at least 12 months runway left because they need to make sure that you can actually pay it off as well.
And that's definitely something for many founders to consider. Um, what about the run rates? This is probably the last piece we haven't talked about. I've also seen some data about last year's and the fact that now we are required to have a lot larger run rate, even by the VCs than you had to have before. What's the good practice there when
You
founders are
mean
thinking
run
about
rate like how we forecast what ARR would be, or
uh,
runway like how many
runway?
months the
Yeah,
company
sorry,
can live
sorry.
on?
Yeah, runway.
Runway.
So how much money you
Yeah.
need to raise in order for you to be like best practice?
Yeah. So there used to be that it should last 24 months. Now I think it's more at like the 18 months. Like whenever you raise, it should last you like 18 months. Obviously, some companies at pre-seed, I see it typically lasting companies only like a year. At seed stage, it lasts them maybe 18 months. At Series A, I see it lasting like 2 years because they're much bigger rounds as well. Unless it's like a Gen AI business. I think we talked about that yesterday, or I talked to somebody yesterday about that. Gen AI, if you're trying to compete with like a chat GPT, you have to raise a ton and deploy a ton because talent now is so expensive because data scientists like OpenAI data scientists apparently are now asking for 2 million annual salary. So if you want to compete with that as an early stage startup, you have to front at least like half a million, like 500K for a data scientist to even compete in this game to get like a good candidate. So those are things to take into consideration. How much do I have to raise so I can actually keep like that kind of salary and that kind of staff on payroll?
Sure. And in terms of you mentioned Gen AI and the AI space. I remember that at least like half a year ago, most of the companies that were funded were in that space, and they had again crazy valuations, very similar to what was happening with blockchain some time ago, even though it was the worst year on the market. Uh, do you see any shift there? Is it like slowing down? What's happening in the space now?
Yeah, so it's interesting. I think there's like this combination of excitement with a little bit of like fear and chaos. It's kind of like when crypto came around and NFTs, they were like the ones that jumped on it, and the other ones that were more on the sidelines, like, I'm gonna wait this out and see what happens. Funny enough, because I think last year everybody says like 2023 was like a tough year. And typically, so we didn't talk about timelines yet. So typically, when we work with a company, how long it takes to fundraise, it's like a minimum of 4 months, but we're seeing like typically average 5 months or 6 months to do a raise. Seed, Series A, doesn't matter. But depending on the sector, it might go faster. So I'm saying that because we had the wildest, fastest deal last year in December. It took 1 week to do like a fundraise for a seed stage Gen AI business that like 1 million in revenue and just like went like hotcakes. It's like investors like were jumping on it because they were really interested in them because they had enterprise SaaS contracts and some like in the pipeline, so it went really fast. But Gen AI, I think it's all about. We talked about that yesterday too, but it's about like the moat. What's their secret sauce? How are they different? Is it really generative AI, or are they just repurposing something that's out there, open in the market and available? I think that's really important. And like, are they using like LLM and like is it like proper like deterministic models or what are they doing? So it's really the secret sauce that everybody alludes to that really makes a difference.
Yes, yes, of course. Like the more proprietary technology you have in the AI space, the better for you. Of course, it's also extremely unstable because almost every new, open AI update destroys quite a few companies. So Yeah, tough space to navigate. I think we discussed most of what I wanted to talk about. Maybe some general, maybe the last general question here. Uh, are there any other mistakes that you see that founders are doing that you would like to mention, whether early stage or later stage?
Um, so I think the most important when you're fundraising, early stage at or later stage, is don't discount when you're talking to juniors at a VC fund. So we have a lot of founders, they're maybe like in their 50s, and they're like, oh, I don't want to talk to an analyst or associate. I want to talk straight to the partner. And we're like, while we have the partner connection, you still are going to start with like the first deal sourcer, and you want to make sure that they understand your business, even though sometimes they might not have the industry knowledge because they haven't worked 20 years in that space like you have. You need to be able to convey why are you different, why are you better, and just give all that ammunition to the associate or analyst or maybe principal or VP that they can write a perfect like investment memo to then showcase to the partner why should we talk to this company. So it's being like thoughtful and like when you're talking to the investor to bring everything across that you think is really valuable and important that the partner will listen. So that's one. And then also like the attitude about valuations that I mentioned and attitude in general. We have like some like founders that we've passed on, we couldn't work with them where they're like, oh, well, I don't want to jump through like a lot of hoops and have to do like five, six calls until I get a term sheet. Well, that's the game. I'm sorry. You're gonna do like three, four, five, six calls before you might even possibly talk to a partner because you're going through analyst, associate, VP, etc. Then they'll do tech due diligence calls. They'll really take apart your tech. If it's a lead investor, they do everything, right? They do customer reference checks. They're going to do background checks on you. Like they're going to do a lot of checks. Nobody wants a Theranos happening again, right? So they're going to really, really grill you. And they might have a questionnaire this long with questions, which might take you a week of essay writing to answer all these questions. And some founders are like, I'm not going to do that. So that's something to keep in mind. And especially when you're doing like a smaller raise, maybe it's like a 1, 2, 3 million raise. What I've seen, the smaller check writers typically ask the most questions because for them the money means more. So if it's like a small emerging VC fund, they're on their first fund is like a 5 million fund, they're going to do much deeper due diligence than a tiger will do that does like 100 something investments a year, right? So, but you might not be able to get in front of a sequoia or tiger, right? So you have to deal with what you're handed, and I think every experience is a learning experience. So even if you went through 10 calls and you did all this essay writing and then they pass, it's a great learning experience. And all these things you can put as FAQs in your data room for future. And then another investor can just read through that. Because some founders are also like, oh, they can just go to my data room and find everything there. Well, not everybody wants to have to read through like pages and pages and folders and folders. They want it handed to them, even if it's readily available in the data room. It's the worst you can say is, oh, just go into my data room. It's there. Please answer the question thoughtfully and write like a nice message.
All makes sense. Now, when the listeners will listen to the podcast, they will have the all-around strategy and best practice
Yeah.
advice of what to do. Um, what's the best way to connect with you, Steph, for maybe your future clients? Is it email, LinkedIn? Shall we put your email onto the
Everything.
episode
Yeah, you
description?
can put my email. It's stephanie.rieben@diademcapital.com. You can go to diademcapital.com, sign up. We see it right away. We have a chat as well. So when you chat there and just go on our website, we're all responding. So that's how you can directly talk to us. And LinkedIn, if I didn't mention. And we're here to help. We're really founder focused. So we're here to help like founders get like the right capital at the right terms and fair terms. And what the nice thing is about like our models, number one, the warm intros, but also we get feedback. So every investor, after they have a call, I hit them up and I'm like, hey, how was the call with so and so founder? What did you think of them? What do you think about the business? Is that a company you see progressing through like your diligence process? Like, will they have a second call, third call, etc. And every time they come back after each call, we get nice feedback, which then we give back to the founder to also help them change the script, change like the story a little bit if there's some little nuances that we think they can change, and we help them. That's why when we're doing a price round, we're very specific who we go out to. Like we go first out to lead investors, then we go to co-investors. With the lead investors, we start with the friendliest first just to see and get some feedback what they think of our founder. And then we go up and up to like the more tougher VCs that we know will ask like a lot more questions.
Great, great. So thank you very much again, Steph. I'm sure this will be useful for the listeners, and hopefully a lot of the people will reach out to you. Thanks again.
Sounds great. Thank you, Jozef.
And that's it for today's episode of the Startup Huddle. Thank you very much for listening, and make sure to catch all episodes on the startuphuddle.com and follow me on LinkedIn and Twitter for more insights and updates on the world of startups. Thanks again for tuning in.